heart of where innovation, money, and power collide in Silicon Valley and beyond. This is Bloomberg Technology with Caroline Hyde and Ed Ludlow.
Caroline Hyde of Bloomberg's World Headquarters in New York. Ed Ludlow, who's off. This is Bloomberg Technology. Coming up, as Apple's smartwatch ban, it looms, the White House is tracking the case with the potential to overrule the import halt decision. We'll break down the latest from Washington. Plus, ByteDance sales reportedly surged this year to more than $110 billion, potentially overtaking competitor Tencent. We'll break down what it says about the state of TikTok's e-commerce business. And we'll discuss how hot or not the private secondary market is, while startup employees and investors, they seek to sell shares of their red hot companies. But first, let's check in on these markets, because still relatively hot. When you're looking at the NASDAQ, we're still managing to push up about 0.25 percentage point. In fact, NASDAQ 100 at another record high. Bond markets, they're also managing to rally. The everything rally is back upon us. We're still feeling that some of the economic data is coming in strong, that consumer confidence building, and indeed maybe the macro picture means that we'll be able to tame some of that interest rate hikes and indeed some interest rate cuts coming some 2024. Just think about what's happening over in the UK. Great British pound actually sinking as that inflation data shows too there. We're seeing cooling in inflation. Look at what's happening on the individual movers and case-by-case basis. I'm looking at number one. China didn't see the mood music of buying that we've seen currently here in the United States. And the NASDAQ Golden Dragon just on the downside by 1.2%. This is that we see maybe some of the big e-commerce players feel the pain coming from one particular ByteDance. We'll dig into that in a little bit later. I'm also looking at what's happening with Alphabet, though, of course, Google. We're going to be digging into what really the changes at Google Play Store are going to be. Not much, it would seem, in terms of a business model impact. So the investor base likes that. And I'm also looking at what's happening with Apple, because this is the key story upon us. Will they indeed see a ban being enacted on the import of their watches? What does that mean? And how much at the moment is the Biden administration currently tracking the impending US ban? We understand they are, of nearly all Apple Watch sales. They're due to, of course, all surrounding a patent dispute with the power to veto the decision resting with the US trade representative. Now, we discussed this with the CEO of Massimo. Of course, this is the company that is currently feeling that its patents are being infringed. And the CEO there told us that, look, thus far, the administration has been in touch. Take a listen.
So I don't expect the administration to step in here. And every time Apple contacts them, I guess by law, they have to call us to get our response. So yes, we've been in contact with them, and we don't think they will intervene. I think their recent stunt to pull the products off the market a few days earlier than the ITC decided it should be pulled off the market, they're trying to get the public to force the Biden administration to do something they don't think they should do, but I don't think it's going to work.
I'm pleased to say Bloomberg's Linda Ann, who really helps drive the coverage for the team here in New York at Technology, joins us. Remind us, go back to basics. We're thinking that some sort of import ban will be enacted because, well, Massimo thinks his patent's being infringed here.
Well, first, Caroline, thank you for having me. It's nice to be with you. So this all stems from this big International Trade Commission case in which the agency ruled that Apple had violated two very important health technology patents in developing some of its most recent Apple Watch series. And as a part of that ruling, they imposed not only a U.S. ban on the equipment that Apple needs to assemble its watches here in the U.S., but also an injunction that will essentially block Apple from directly selling those series of Apple Watches here in the U.S. And as you noted, we're counting down the days to that actual ban. I mean, we're talking about like right after Christmas that ban takes effect. And, you know, as the CEO of Massimo just characterized as a stunt, Apple is deciding to sort of wind down the sales ahead of that end of Christmas Day injunction.
And of course, a key selling time, a key issue when you think about what's over in the UK, a Boxing Day sale, the idea that everyone goes out and starts purchasing like they do after Thanksgiving here in the US. What therefore here in the US does it mean when a fix could or could not be enacted? Because Massimo, the CEO, was saying that he didn't think this could be some sort of software update ultimately.
Yeah, I mean, he was saying that it would have to be a hardware change, right? He was telling us that for days. And if a fix cannot be enacted if there is no deal that is reached between Apple and Massimo. If the White House doesn't step in, because it has had almost 2 months to decide on a veto, then you do see the sales directly from Apple affected. Now, one thing that I wanted to clarify, you said all Apple watches will stop in sales. That's not necessarily the case. That is Apple's direct sales from its own retail stores. So I just want to point out that you can still go get your Apple watches at Best Buys, at Walmart's, not to give them any, free marketing, but they have said, these other third-party retailers have said, we will continue selling these watches. What remains a question is what happens if the inventories at these third-party box retail shops end up drawing down? Where did they get the rest of it? Can they still bring in those devices from Asia or other manufacturing centers by Apple and keep those sales going for Apple? Like, we don't know.
And I wonder whether it kickstarts some sort of rush.
Yeah, well, I was saying the other day that I'm glad that I got my Apple Watch before that. We have been checking. We've sent reporters out to Apple stores to see if there has been a rush. No rush yet, but you never know.
Okay.
Let's see.
Love that on the ground reporting. Go on there. Also, no marketing for Apple here, but just the odd perspective on where on indeed, if you can still purchase it. Let's just continue the antitrust side of all of this and ultimately what it means for patents in the longer term. Let's bring in Nicholas Mattich. He's principal at McCool Smith's intellectual property practice. And how often have you seen this sort of tactic being used, Nicholas, really with Apple sort of getting ahead of an ultimate potential ban and trying to force consumers perhaps hand here?
It's actually been very rare in recent years, primarily because injunctions or exclusionary relief like a ban on importation have been pretty rare in patent litigation since Supreme Court decision in about 2006. So there just haven't been occasions where a major player like Apple would frequently face this kind of situation.
Of course, we were just debating as to whether the US trade representative or indeed the administration would in any way step in here overall. Just give us your perspective on what the pros of doing that and what the cons are of ultimately a government weighed in here.
Well, I mean, the pros are obviously people like Apple Watches, and that would be a politically popular decision. The cons are that it doesn't, it doesn't promote innovation in the U.S. because that's why patent rights are important, and a company like Massimo is entitled to either license its patents to Apple on the terms that they think are appropriate, or to use their exclusivity from the technology they developed to gain market share. And if Apple if Apple doesn't want to do a deal with them or come up with its own solution to the technical problems Massimo solved, then Apple's going to face a ban like this, or at least have to offer products that don't have this feature.
We were speaking with the CEO of Massimo this time yesterday, and his points were clear. He felt that his chief technology officer, his chief medical officer had been lured over to Apple. There was nothing he could have done in terms of paying it even further. They just had the resources that couldn't be matched by a smaller company such as Massimo. And I'm interested as to the other clients that you serve, the conversations you have. How much is this sort of behavior happening, if indeed it is exactly what occurred?
So I hear that kind of story all the time from clients of a large technology company taking their intellectual property via trade secrets or patents, and then using their other market advantages to beat the smaller guy. Patents are fundamentally a tool of small companies, and we need them to incentivize small companies to invent the next technology, because small companies are where the groundbreaking innovation tends to occur. And if the bigger guys, they're always going to win if they're allowed to copy, because they have the pre-existing market advantages. They've got a well-known brand, the consumer base, distribution channels, and what the small guys have is their innovative technology. And so that's why it's so important for to be able to enforce intellectual property rights the way Massimo is.
To that end, do you anticipate that, if you were to put probabilities on it, some sort of deal will ultimately be reached here? Massimo's been spending millions, yes, to ultimately potentially prove a point here and to fight for the smaller companies, but also because it thinks it could win a lucrative deal ultimately.
don't know. I mean, I don't know what Massimo's business objectives are. They have said they're willing to do a license. The question is always at what price, and is it a price that they're willing to take and Apple's willing to pay? And it also probably turns a lot on what happens on the 25th or the 26th when the president has to issue his decision. ITC vetoes are extremely rare. In fact, I think there's only been one in history. Now, Apple was the beneficiary of that one veto, so it may be feeling a little bit of invincibility here because it has such a well-known brand and such political clout. But we'll have to see what happens, and if the president doesn't veto it, that may bring Apple to the table.
Nicholas, it's great to get your expertise. Thank you for spending some time with us. Nicholas Mattich of McCool Smith. TikTok owner ByteDance saw sales surge in 2023 to over $110 billion. Now, that's all according to people familiar with the matter. That would put the company ahead of rivals like Tencent. And of course, it says ByteDance is seeking to expand, particularly in the area of e-commerce. For more, let's bring in Bloomberg's Henry Wren joining us from London. And Henry, when you're looking at what the driving force of this sales pickup, I mean, it is phenomenal percentage point growth here. Is it at the expense of market competition?
So as our Asian colleagues broke this story, so as you said, so ByteDance, its revenue is on track to exceed $110 billion US. And its growth driver really comes from e-commerce, as you mentioned. It's not just overseas, but also at home. So at home, it's expanding rapidly into areas such as helping people to book restaurant tables, helping people to book restaurant takeouts, but also selling clothes online, but also overseas. For example, just earlier this month, it bought Indonesia's Tokopedia, which is one of the major e-commerce platforms in Indonesia. And remember, Indonesia is one of the biggest e-commerce markets in Southeast Asia. So as you said, it's expanding rapidly overseas in e-commerce offering, but also at home as well. But it can be at the cost of some other competitors. For example, Meituan, another food delivery platform in China, but also Alibaba, which is under pressure by not only PDD, but also ByteDance in e-commerce offerings front.
Talking about pressure, we're seeing it managing to scale at home despite a weakening economy. We're seeing it particularly showing strength in e-commerce now, having done that $1.5 billion deal in Indonesia. But here in the US, there is still some political anxiety. Are we likely to see that continue into 2024?
Exactly, especially when you think of 2024, it's an election year, and the climax was really in March this year, right? So when you remember the TikTok CEO, Shou Chew, appeared in Congress, testified before Congress when some lawmakers threatened to ban this app completely in the US. And I would want to point out that the regulatory pressure is not just in the US, because when you look at India, which is another big country, and remember this year India surpassed China as the most populous country in the world, the TikTok app is actually banned in India. And there's no promise that those regulatory pressure won't rise in China as well, because what we've been seeing, Chinese government has been cracking down severely on platform companies domestically as well. So as you said, regulatory pressures could be coming, but also on multiple fronts.
But for now, it seems as though the growth is still about 30% year over year. So revenue really managing to rise up amid some of that pushback here in the US. Henry Wren, great to catch up with you as always. Thank you so much. Meanwhile, let's stick with ByteDance and ultimately how we're seeing brands, companies really launch themselves in popularity using the power of influence. Jacob Cook's with us, WPIC Marketing and Technologies co-founder and CEO. You are staying up late, friend, over there in China. And I'm interested, Jacob, ultimately the sort of sales growth that you hear, reporting of 30% year on year, is that what you are seeing bear out with your own data?
You know, domestically, we're seeing it in line or actually even a little bit higher with what we're not surprised by that number at all. We would have actually seen it coming in mid-30s, maybe 36, 37. It really is, you know, the platform of the younger generation as we're seeing these consumers, you know, really the Gen Z really come into their own right now. This is what they're using to shop. And it's, you know, it's an interesting transition. It's happened very quickly. And we're pretty excited about it. You know, everything that was in the Bloomberg article and has been released today is right in line, if not low, quite frankly, from what we're seeing on the ground over here.
And talking of what you see on the ground and do on the ground, you're basically helping perhaps Western companies, brands access Asian buyers, whether or not it's in China, Japan, South Korea. How much are they leading with being on Douyin, being on these sorts of e-commerce and meets content platforms at the moment?
Yeah, the brands that we're dealing with in China certainly, this isn't new. This has been going on for a couple of years now. They're definitely benefiting a lot from these growth numbers. And, when we talk about, you mentioned before about, a weakened consumer over here, we really look at different categories, right? So that, large durables and things like that have shown weakness, Douyin's really not exposed to. So what they're seeing, fashion, health and wellness and these other categories that, the younger consumers are really engaging with, ByteDance is really well positioned for that. So these growth numbers that we're seeing coming out today, again, right in line with what we're expecting. And, next year, I think we're going to see this again, if not better.
What sort of ROI is a brand getting when they invest in putting content on the platform, but also selling via it? Because, well, they must have to pay an upfront fee to certain influencers they work with, for example.
Yeah, it's definitely a different model for ByteDance. ByteDance has a really easy platform and a back end to engage with influencers. Now, there's a lot of them out there, but they can be charging, 30, 40, 50% commissions, which isn't unheard of. We go back to sort of what, the big influencers were doing on Tmall a couple of years ago as well, or Taobao Live. It was about the same rates. Now, ByteDance is getting a much larger percentage of that, which, leads us to believe they're in a much better financial shape. But, brands are willing to pay that because, again, you can put your product or service, and again, restaurants, dental cleaning, you name it, in front of millions of people very, very quickly. And you've got to have a little bit of faith in your product, too, that, that second or third purchase, they're going to come back to the brand directly where you're not going to have to pay that fee. So, again, it doesn't work for large durables, which are one-offs, but it does work for cosmetics, nutraceuticals, athleisure, and things that can be repeated again and again and again. So we're seeing, brands do very, very well that are engaging in that model here.
Always great, Jacob, to stay up with you, for you to give us your time when it's late, and we need to get your on-the-ground expertise as well. Jacob Cook of WPIC. Stay well. Meanwhile, coming up, we've got some breaking news for you. This is as the FTC, we understand, of course, the Federal Trade Commission, is proposing changes to children's online privacy protection rules. They're saying that they're going to place new restrictions on the use and disclosure thereof of children's personal information. This is according to a statement coming from the FTC. Of course, this is as we see ongoing concern about, well, the access of data and children's interpretation and use of some of these social media companies and, well, more broadly, the internet. Let's talk a little bit about, well, where else we're seeing some changes. Alphabet's agreement, for example, to end abuse of market power on its Google Play Store may come with a catch. We're going to delve more into that in a moment. Meanwhile, let's just check in on the shares of Zoom today. That Wells Fargo securities analyst Michael Turin, he's out with a recommendation to cut ultimately the price target on Zoom. He's also saying go underweight from equal weight. We're seeing a price target now with $70, currently trading at 71.48. We're off by 1.3%. This is Bloomberg Technology. Time now for Talking Tech. First up, well, the FTC's been busy, and the Federal Trade Commission on this part is also saying that Rite Aid must stop using facial recognition for surveillance. According to the FTC, Rite Aid's system generated thousands of false matches, often involving race, and without notifying customers. Rite Aid can't use the system for the next 5 years, which was to be allegedly spotting shoplifters. Meanwhile, Chinese internet company Alibaba is in the midst of an executive shakeup, replacing commerce chief Trudy Dai after a roughly 20-year stint. Now, Dai will instead help set up a holding firm for managing some of Alibaba's global assets. Plus, claims on bankrupt crypto exchange FTX are soaring, trading at 57 to 73 cents on the dollar, depending on the size. And this is according to data from Cherokee Acquisition. Still unclear whether distributions will actually be made or how much customers and creditors will ultimately receive. Meanwhile, let's talk about, well, a rather little amount the customers are going to be receiving from the Alphabet case. The $700 million deal, of course, was agreed to alter its Google Play App Store. And many are now pointing out some of the loopholes around developers' service fees. Let's get more context. Bloomberg News reporter Malti Nayak is here. And before we get into the fact that a consumer in this case would get about $2 potentially back from Google from the $700 million settlement. But ultimately, what people are nitpicking here is the fact that they're probably not going to have to change their business model all that much, the amount that they charge a developer.
That's right. So Google has made a concession here with this deal where they are going to allow developers to give users access to alternate payment options, like they could use PayPal or anything else, have their own billing system instead of going through the Google Play billing system. But, they used to previously charge 30%. Now they're offering a discount of 4%. At 26%, a developer is still paying a hefty service fee. And I'm not sure whether, the 4% discount will actually sort of go down to a consumer where it'll actually benefit a consumer. So there have been some folks who've been sort of watching what Google has been doing over the years with its Google Play policies. And it seems like they are concerned that this settlement doesn't go far enough to really benefit developers and consumers.
For example, Epic, which actually just won against Alphabet last week in court. In particular, Corey Wright, the VP of Public Policy, is saying ultimately this doesn't in any way help consumers in terms of overpaying. So will we see any change to the business model if it's not forced by the courts?
So I think it'll be interesting to see what will happen in court because Epic won a case against Google Play's policies, which they challenged on antitrust grounds. And next year, the judge is going to actually think about how Google Play policies should be revamped. Should there be this standard, 30% commission fee or, even at a 4% discount? Should developers have to pay Google this service fee? And Google, in its defense, says, we have to keep our Android system going. We got to invest in it, so we got to charge the fee.
Malti.
So we'll have to see what happens in court next year.
Thank you so much, Malti Nayak, who's been all over these court rulings. Coming up, we'll get a read on liquidity in the private markets with Oceanic. Stick with us. This is Bloomberg Technology. Welcome back to Bloomberg Technology. I'm Caroline Hyde in New York. Let's get a quick check on these markets because we're managing to power on higher. Maybe it's still this optimism that we'll start to see rate cuts as soon as March of next year. Federal Reserve Bank Philadelphia President, that's Patrick Harker, actually making some headlines as we currently speak. This all on the back of whether or not we will indeed see a need to pull back in terms of the rate hiking cycle. Harker saying you don't need to raise rates anymore. You should hold steady. We're currently up 0.3% on the NASDAQ. We're seeing bonds managing to rally on the back of hopes that we'll see consumer optimism as it currently hits a high today also be fed into the fact that we can get some sort of soft landing here in the US. Remember, there's a 20-year auction a little bit later. Bitcoin actually getting a bit of a bid as well. We're up 3.3%, having been sold off a little bit of late. It's getting crazy out there. And of course, it's not just Bitcoin doing well. The altcoins are back. Doc with hat, as it's called. Yep, a dog pictured with wearing a hat seems to be doing particularly well at the moment. But so too is the NASDAQ more broadly. Look at that, 54%, let's call it, year to date in a rally. And today we're once again at a new record high for the big tech benchmark. But what does the public market feed into the private market at the moment? How much are we seeing valuations still under pressure or indeed rallying on higher? Let's focus in on that secondary market now and whether it's a good time to buy into some of the hottest startups such as OpenAI, SpaceX, amid those tender offers from employees. Joining us now is an expert, Tim Sullivan, Oceanic Partners CEO. Oceanic, you're a venture capital company, you're an advisory firm, and you really focus on ensuring liquidity is there within the investments that you make in the private markets. And ultimately, Tim, are we seeing decent liquidity for some of these hottest names?
We definitely are seeing liquidity coming back. I would say in some of the names like OpenAI and AI in general, those cap tables are pretty small, and so there is not a lot of liquidity. But in most of the other big names that are transferable, we are seeing liquidity coming back, and we are seeing pricing at much lower levels than we've seen it over the past 2 years.
And so is that why there's now this anticipation of rates coming down, risk tolerance coming back, and wanting to buy in at these cheaper prices? Who are the sort of people putting in those bets at the moment, Tim?
Yeah, I think to some degree, risk is coming back on, and at the same time, a lot of the shareholders that have been waiting for liquidity for the past 2 years, waiting for the markets to rebound, are somewhat running out of air. They need liquidity. Without companies going public, individuals literally, they need capitals to survive for renovations, for taxes, for mortgage rates going up, for emergencies, et cetera. And so at some point, they're going to start looking for liquidity. And the reality is that the buyers, who have been primarily institutional for the past couple of years, they have not moved their bids. They have remained low based on fundamentals, and sellers are now coming down to bridge that gap.
Those sellers primarily being employees, are we seeing any early investors wanting to liquidate as well, needing to perhaps satisfy some LP demands?
Absolutely. There are plenty of early investors that are looking for liquidity. No one knows how long this current situation is going to last. Is it irrational exuberance that we're experiencing right now? Will we see the rate cuts next year, and will that have a material difference in the markets? It's hard to say, and some people can wait for another 2 to 5 years, and other people can't.
I don't want to ask you to pick a favorite child, but are there names that you're seeing time and time again being analyzed, being bought up, and are they the ones that we're still talking about IPOing in the near future?
Oh, absolutely. I think, there's rumors moving around right now that OpenAI may do a raise or an IPO in first quarter next year just to beat out XAI. There's companies like Databricks and SpaceX that have been pretty resilient throughout this meltdown. And they, who knows? I think, if the market conditions are appropriate, we'll move their IPOs up. Not sure about SpaceX. They're probably a few years out, but companies like Databricks and Stripe and some others may be sooner than you think.
There's always been this hope for democratization, Tim. The idea, we saw Cathie Wood with ARK offering up this sort of VC ETF, allowing normal people be able to have access to some of these pre-IPO names. Are we seeing syndicates come in? Are you seeing sort of angel teams coming in to buy in on this stock and allowed investors, but perhaps not people with billions under management?
We are, and I have mixed feelings about that. I think without legitimate information, without Qs and Ks being filed, regular, normal people, as you call them, are not equipped to do the diligence necessary to invest in these names. There is a lot of risk and a lot of downside. So it's not for the faint of heart. If you have access to information, either directly or indirectly, I think do your work and make the most educated decision that you can. But if you don't have access, it may be best to stay away.
Tim, can I ask, therefore, some of the institutions that you say have stood firm, still standing, wanting to take a bid, but wanting it to be a lower valuation, are they all US institutions largely, or are we getting foreign buyers coming in?
We are definitely getting more and more foreign buyers in, but by and large, it's still a US market.
And I'm interested as to ultimately whether you do think the IPO market's going to pick up. You were just talking about whether there's rumors indeed swirling of an early initial public offering, even from an OpenAI. But there has been this drumbeat that we'll start to see more names come in 2024. Is that likely to happen? Will the exits be there?
I look at it from two different perspectives. Number one, I think if the market does come back and irrational exuberance wins the day, then absolutely we'll see IPOs in 2024, maybe as soon as late Q1. However, I see things like inflation and unemployment and CPI and real macro factors that have not changed as much as maybe they need to support that ongoing next phase of the market. And if the irrational exuberance fades, I think we're out into late 2024, early 2025.
We have, of course, heard OpenAI, SpaceX tender offers and boosting their valuations. How rare has that been?
That has been extremely rare. And I think, I hate to say it, but a lot of the valuation talk around those specific companies is driven in the media. I don't know that the numbers still support those valuations. Those are a couple of companies where the valuations are not based on fundamentals. And at some point, I'm sure they can grow into those valuations, but most of the companies out there today are trading more along the lines of fundamentals. And when I say that, they're trading at discounts of 50 to 70+% of where they were trading in late 2021.
Wow. And is there any sort of, great themes we can see as to whether it's the fintech space that's taken the most hit, whether it's the companies exposed to a consumer, or really is it just across the board? You've generally seen a clip or a lower of 50 to 70%.
It's absolutely across the board, with, as I mentioned, a couple exceptions.
Tim, it's great to catch up with you. Thank you so much.
Thank you, Caroline. My pleasure.
Tim Sullivan, Oceanic Partners CEO, is going to be busy in 2024. Meanwhile, coming up, look, Telefonica shares over in Spain surging after the government announced plans to take a 10% stake. We'll have the details next. Meanwhile, let's just take a look at Tesla. We're seeing talk of maybe managers being told that some salaried employees aren't going to be being offered merit-based equity awards this year. The company didn't give a reason for the change, but 4 employees from different departments told Bloomberg that they believe the move is pretty widespread. Workers, they still get a modest cost of living increase, they get adjustments to their base salaries, but perhaps some of those stock options just being dialed back a little bit. We're off by 0.6%. This is Bloomberg Technology. Sony's Insomniac Games division has just seen a massive leak as hackers released over 1.3 million files detailing footage, roadmaps for upcoming games, tied particularly with Marvel. For more, let's bring in Bloomberg's Margie Murphy, who joins us now. And for many, you go back to 2014 and Sony Pictures. This is a games division of Sony. And what sort of details are being leaked here, Margie?
Yeah, so as you say, 1.3 million files. It was a really big leak. We can see employees' personal details, which is pretty bad. So lots of passports, social security numbers, addresses, and lots of HR documents, financial documents about budgets, banking details, wire transfers, and then kind of the more sensational stuff, which is the footage from games that are slated to be released in the coming years. So Wolverine, you can see all the material for all the Marvel scenes that are coming up, upcoming missions, trainings. So really a huge leak for this developer studio. And actually the video game industry is, been pretty prevalent since 2022. Some of the big hacks occurring. I just think what's happened with Grand Theft Auto 6 as well, getting leaked ahead of its official launch. I'm interested in who's behind this particular attack and what we know about them. Yeah, so this group is called Rysida, and we've known about them since about May of this year. They are a ransomware as a service group. So people will come to them, they will give them a target, and they provide the malware that is used to attack their target. And then they share out the ransom demands with their affiliates. So we understand that probably around 25th of November, the group was able to infiltrate Insomniac. And then Rysida would have basically told them, we've stolen all your files, we've encrypted them all, and if you don't give us 2 million worth of Bitcoin, we're going to release them. And we know that subsequently they sold some of the files on the criminal market and leaked the rest this week.
Predominantly, who does Rysida tend to give malware to hack? I mean, is it the gaming industry more broadly, or is it cross-industry?
So they seem to be targeting, I'll call it lower hanging fruit. So they've been going after smaller companies and organizations that maybe their security isn't as tight. So they've hacked Sony essentially, but through a kind of subdivision of Sony. And their most recent high profile hack was the British Library. And they target manufacturing, and they've been targeting healthcare and schools as well. So these smaller organizations are normally forgotten by the big time hacking ransomware groups. But they've been going after these smaller groups and having some success with them. But it means that their extortion demands are normally lower. And it normally indicates that the hackers themselves aren't that sophisticated. So the malware is, it can infiltrate lesser secured systems, as it were.
Still, the need for cybersecurity ever present. Margie Murphy, thank you so much for bringing us that news on Sony. Meanwhile, let's just shift gears a little bit and go to Europe, with the Spanish government planning to buy a stake in Telefonica worth as much as $2.2 billion. Look, this is in a bid to safeguard one of the nation's most strategic assets. And that's as Saudi Arabia builds up its own position in the company. Bloomberg's Thomas Seal joins us now from London. And it is interesting that this has been a company that for years is trying to distance itself from the government and now, well, has to go to them a little bit closer.
Yeah, it's fascinating. As the government moved out, Middle Eastern governments have moved in on European telecoms. And this isn't the first example. Vodafone, one of the biggest telecom groups in Europe, had a UAE-backed company buy up almost 15% of its shares in the last couple of years. So this is somewhat of a trend. It's a trend. Ultimately, how much are they concerned about foreign ownership more broadly? Is it particular Middle Eastern names that they seem to be pushing back against? And ultimately, what's their vindication? What's their reasoning for it? Well, certainly on the second question, telecom firms, they're a bit dry, a bit dull sometimes, but they underpin everything we do. And COVID showed that, obviously. We were all dependent on them to do everything. But beyond that, defense, government, cables, big business, banking transactions, these are all reliant on, a handful of, often in the case of Telefonica, in the case of in the UK BT, these formerly state-backed companies. And now, the state is stepping in once again. It's also interesting, other rivals to Telefonica still have government stakes, so it is sort of a return to that status quo. Deutsche Telekom has a big government stake, and Orange in France, formerly France Telecom, has a government stake as well. What's interesting, though, of course, is that Telefonica isn't just all about Spain. It's also about Latin America, part of its business there. So what does it mean for building businesses abroad? Well, I don't know if the Saudi telecom company, backed by the Saudi government, has explicitly gone through its plans, if they have them, for Telefonica. But there's a lot of pressure on the telecoms industry generally to maximize the value of assets. It's been a terrible sector for share prices, one of the worst globally. And so there's been lots of carve-outs of infrastructure and lots of sales of local units. So possibly the Spanish government is stepping in to make sure it has a voice in those discussions. Telefonica, big player, with market capitalization 21 billion over there in Spain. We thank you for bringing us the latest. Thomas Seal on all things Telefonica. UK-based fintech firm Revolut, it's on track to generate more than $1.9 billion in revenue for the year. It's actually Europe's most valuable startup, and it's benefiting from rising interest rates across the continent, of course. Revolut is now adding as many as 300,000 users a week, according to people familiar with the matter. However, the startup, which was most recently valued at $33 billion back in 2021 funding round, still has yet to receive its banking license from UK regulators. Meanwhile, we're sticking with fintech. We're talking about perhaps the holiday season within it. We're in full swing. While many of you, including me, shop online, you're also going to be seeing bricks and mortar come into their own. And a New York-based fintech startup is focused on that traditional part of retail. Bonside is a company that's looking to offer passive income to investors willing to bet on traditional bricks and mortar. I'm pleased to say that Neha Govindraj is with us, Bonside founder, CEO, and the passive income play here is, look, come on board, help lend to a company that's growing, and you will get a nice return. Meanwhile, the company, doesn't have to sell equity? Is that kind of the win for them?
That's exactly right. So our intention is to provide a passive income opportunity to investors, and they provide their capital in exchange for a percentage of sales rather than a percentage of the business. And so as a result, they start seeing their repayments from the business in month one versus waiting for a year 7 to 10 outcome before they see the returns from their investment.
And all of this, I'm sure, is to give more options and optionality to a retail investor who's looking for yield. How much have you had to focus in on ultimately education here? There is a lot of concern about the democratization of finance, meaning basically we all got showered with confetti every time we bought a stock. How have you thought about educating a consumer on this?
education has been incredibly important in what we do. So we went to market coining our agreement as the repeatable revenue agreement. Mm-hmm. And the intention behind that was we wanted to shape the investor's perspective of what we do versus relying on their existing understanding. And so it gave us a new opportunity to actually educate the investor base and say, hey, this is how we do things, and here's every piece of the fundamental that you need to understand about our agreement before you get involved. As a result, we've kept the product just for accredited investors, but we think about that as we expand how we can broaden the base.
And it's coming in expansion at a time when maybe the mood music around the consumer and the economy gets a little bit better. How have you managed to see companies perform and show resilience? I mean, you're lending to really well-known restaurant groups, but then some individual names that might be a yoga studio, for example, or then a store. Which have done well? Has anyone had problems servicing?
So we exclusively focus on brick and mortar services businesses. And we define that as food and beverage, as you referenced. Then the second category is wellness. So think medical spas, gyms, salons. And then the third category is more traditional care, either provided in clinics or something like a car wash. Mm-hmm. And our belief, especially coming out of the pandemic, is that brick and mortar services is very much here to stay. And if anything, it's on the rise, because we all lived in a world where we weren't experiencing services. And we all decided that's not the world that we want to live in. And so we've seen consistently across our portfolio really strong performance. And of course, that's aided by the rise in consumer spending that we're seeing as well.
I'm looking at sort of Jose Andres Group. Why did they need to access money from you? Why not go to a normal banking partner when you're that big a name, that big a player?
It's a great question. So we really think about our source of financing not necessarily for those that are in need of financing. When we look at the brick and mortar services sector, we believe that the capital stack and the options in their capital stack haven't actually innovated in the way that multi-unit retail has really innovated in the last decade. And so when we look at that, we think about what we're providing here at Bondside with our repeatable revenue agreement as expanding their capital stack. And so it's not necessarily meant to replace the equity on your cap table or replace traditional debt that you have in place, but to just give you one more tool in your belt that you can leverage as you think about growth and scale. And so we see businesses as large as Jose Andres Group adopting us, as well as the younger players that are being a lot more sensitive to dilution than they were maybe 3 to 5 years ago.
What about your cap table? Like, you're going out pitching yourself as a fintech business with a technology valuation. How have you raised funds? Has it been hard, easy to tell your story?
Yeah, so, I really came at building Bondside out of a personal need. Prior to building Bondside, built a brick and mortar business and felt that we were really underserved in the capital options that existed. Nothing quite fit what I was looking for. And so it was very easy to then translate that into a story and really sort of paint the picture for the need there. And so as we think about our cap table at Bondside, when we think about our roadmap ahead, our first product is the repeatable revenue agreement, which, you're right, is a financial vehicle. But when we think about the future, there's a lot of opportunity to serve brick and mortars beyond that.
Neha, it's great to have you in the show. Thank you.
Thanks, Caroline.
Neha Govindarajan there, Bondside founder, CEO, talking fintech to end what is, of course, this edition of Bloomberg Technology. Do not forget to check out our podcast, though. Get up to speed wherever you listen, of course, on Apple, Spotify, iHeart, Bloomberg.com, too. This is Bloomberg Technology.